Unit 11. Prices, Rent Seeking, and Market Dynamics. The context for this unit. Comparative equilibrium is when buyers and sellers are both price takers and markets clear. Equilibrium price responds to exogenous shocks, which are changes from outside the model. Characteristics of competitive equilibrium. Example, law of one price may not hold in actual markets. In this unit we study why might markets not clear in equilibrium, in what ways can prices adjust to exogenous shocks. Market equilibration. Endogenous variables are variables that are determined within the model, such as price and quantity. Exogenous variables are anything else that can affect supply and demand. An exogenous shift in supply or demand means that the price has to change for the market to reach a new equilibrium. In the market for hats shown in the diagram, original equilibrium is at point A with equilibrium price equal to $8 and equilibrium quantity of 24,000 hats. Now if demand increases, there will be a shortage of hats at the original price. Equilibrium analysis you saw in chapter 8 would tell you that the new equilibrium will be at point C, where price will be $10 and the new equilibrium quantity will be 32,000 hats. But how do we get there? With a shortage of hats in the market, sellers will be able to charge higher prices for the hats available, shown by point B, of almost $14, which is higher than the new equilibrium price. They will start making higher economic rent or economic profits because they are charging a higher price while their costs are the same. This will encourage them to produce more hats till they get to point C. More hats will need to be sold at a lower price. As a result, price will begin to come down from the level at B. In response, quantity demanded will increase till the new equilibrium is reached at a price of $10 and quantity of 32,000 hats. This is called market equilibration through rent seeking, which means it is the profit seeking behavior that gets us to the new equilibrium. So the key takeaway is that prices ultimately come from the interest of and the interactions between buyers and sellers. Firms will raise prices when they are able to because that will increase their profits, and buyers will try to pay the lowest price that they can. Market organization determines precisely how these relationships influence prices. Example, trading between two parties / individuals versus auctions. If you are bartering, then prices will be determined differently than if you were buying stocks or a computer. Short run and long run equilibria. So let us think about the difference between the short run equilibrium and the long run equilibrium. Point A is the short run equilibrium. We are holding something constant, the number of firms in the market. Firms are earning rents because at point A we are above the zero economic profit curve. At point A on the graph on the right, we see equilibrium price is €2 and equilibrium quantity is 4,800 loaves of bread. However, since existing firms are making an economic profit, new firms will enter the industry. Supply will increase. Equilibrium price will fall to B and then eventually C, where each firm will be making zero economic profit. This does not mean they are making zero accounting profit. The accounting profit they will be making will be equal to the opportunity cost of the capital being used in this business. We call it normal profit. The long run equilibrium C is where a firm's rent is zero. Price equals marginal cost equals average cost. Or in long run equilibrium, P equals MC equals AC, including the opportunity cost of capital. Short-run and long-run elasticities. The number of firms is exogenous in the short run, taken as given, but endogenous in the long run because over time new firms can enter or leave an industry by setting up new factories or selling their plant and equipment. This means that supply is more elastic, responsive to a change in price in the long run as more firms enter production. Similarly, demand is more elastic in the long run than the short run since it takes time for people to change their habits or find alternatives when the price of a good changes. Prices, rent seeking, and market dynamics at work. Oil prices. To understand what drives the large fluctuations in oil prices, we can use our supply and demand model, distinguishing between the short run and the long run. Prices reflect scarcity. If a good becomes scarcer, more costly to produce, the supply will fall and price will tend to rise. Economists have been predicting that at some point we will reach peak oil production and then prices will continue to rise, but that is not evident since higher prices stimulate further exploration, which is possible in the long run as new wells can be brought into use. Market dynamics at work. Oil prices. The short-run fluctuations reflect short-run scarcity. 1. Demand is inelastic in the short run because of the limited substitution possibilities. 2. Supply is inelastic in the short run because oil wells are expensive to drill and their capacity is fixed. Organizations like OPEC can artificially reduce the quantity of oil coming to the market. A negative supply shock thus leads to the percentage increase in price being much larger than the percentage decrease in quantity. Assets and asset price bubbles. So far, we have looked at the price of consumer goods, but one of the most important things people buy and sell are assets. Assets are things that provide value over a longer period of time, such as a house or a car or stocks. People buy assets for two reasons. 1. To benefit from owning it, such as enjoying living in the house. 2. To be able to sell it later and make a gain if price of the house has gone up. The value of a financial asset, a security, such as stock, bond, mutual funds, depends on 1. The size of the cash flows that it is expected to generate, dividends for stocks or interest payments for bonds. 2. The uncertainty or risks in one's forecast of these cash flows and what you think it will be worth when and if you sell it. That will also be important in determining the price you would be willing to pay for that asset today. Bonds. Bond is just a loan. It will be the same for everybody. The US government and US businesses borrow money by issuing bonds. Those who buy these bonds are essentially making a loan to the government or the business. Bond, a security that promises to pay fixed amount of money at specific intervals. Bond pays a fixed amount of money in interest payments, coupon rate, at specific intervals, along with the principal amount or face value of the bond at the time of maturity. The risk with any loan is that it may not be paid back. The same is true of bonds. The risk of default on government bonds is usually negligible, true for US government bonds but not necessarily for all government bonds. Return on government bonds is at risk of being lowered by high inflation. Money you earn will have less purchasing power. Corporate bonds are not risk-free. On bonds with a high risk of default, high interest rate is demanded by investors, so they have to be offered at lower bond prices in order for lenders to receive a higher return. So when the stream of payments from an asset is fixed, the price of the asset will be inversely related to the interest rate it yields. Stocks, shares, are a claim on a part of assets of a firm and hence on its profits. If you hold one share of Apple, then you own a small part of the company and have a claim on a part of its profits that the company decides to distribute. Companies pay dividends on shares, so if Apple announces a dividend of 10 cents per share and you own 10 shares, then your dividend payment will be $1. Stocks offer no specific promised stream of payments, and the time period over which payments will be made is not fixed. Firms expected to generate greater net earnings will have higher valuations equal higher share price. Risk. Value of both bonds and stocks depends on uncertainty over its earnings. Systematic risk. Events that simultaneously affect broad classes of financial assets. Undiversifiable. Idiosyncratic risk. Events that affect only a given firm/asset. Diversifiable and hence irrelevant for valuation. The rate of return that will induce investors to buy shares in a company is the market capitalization rate. It is higher for companies subject to greater systematic risk. Trading strategies. The fundamental value of a security equal share price based on anticipated future earnings and the level of systematic risk. Trading strategies. 1. Buy assets that are priced below their perceived fundamental value and vice versa. 2. Look for momentum in asset prices, buying when expecting prices to rise further and vice versa. Both types of trading are a form of speculation. Continuous double auction. The trading mechanism in the financial market is called a continuous double auction. 1. To buy. Submit a limit order, quantity and reservation price. Bids are orders to buy and asks are orders to sell. 2. A trade takes place if there is a match between a bid and an ask. 3. If there isn't anyone to trade with, the bid will be recorded in order book. The price is always adjusting to reconcile supply and demand and hence clear the market. Equilibration through rent seeking. If more trades take place at a higher price, the share price will go up. Continuous double auction. The table shows what a continuous double auction might look like. Bid orders show the highest price to the lowest price a buyer is willing to pay. Ask shows the sell orders from the lowest price a seller is willing to accept to the highest price. There is no match here, so all these bid and ask orders are recorded in the order book. If a bid comes in for 600 shares at $16.60, then 500 shares will be sold at $16.59 and 100 shares at $16.60. The order book will reflect those changes. From the ask list, the top entry will disappear and the number of shares available at $16.60 will go down to 600. Please watch the video by Rajiv Sethi in the textbook demonstrating how continuous double auction works. Asset market bubbles. Bubble, a sustained and significant departure of the price of any asset from its fundamental value. Changes in asset prices are messages containing information about the firm's health, etc. If markets are to work well, traders must respond to these messages. But when they interpret a price increase as a sign of further price increases, momentum trading, the result can be self-reinforcing cycles of price increases, bubbles, followed by sudden price declines, crashes. Look at the graph for the Nasdaq Composite Index 1995 to 2004 showing the tech bubble. Resale value, ease of trading, availability of borrowing may all make bubbles more likely. Modeling bubble. Good news about future profitability. Demand curves shift to the right, leads to price increases. Positive feedback. The price increase is interpreted as signal of future good news, leads to further increases in demand. Prices and beliefs. Pictogram shows that beliefs may dampen or amplify price rises. Stable equilibrium. An equilibrium is stable if there is a tendency for the equilibrium to be restored after it is disturbed by a shock. The price dynamic curve is flatter than the 45-degree line. Horizontal axis shows value of variable in period t. Vertical axis shows value of variable in period t plus 1. Starting with price P0, if price rises to P1, in a stable equilibrium, it will return to the original price. Price dynamic curve shows that the higher price in period 1 will be followed by a lower price in each period till price reaches its original point. Unstable equilibrium. An equilibrium is unstable if, when a shock disturbs the equilibrium, there is a subsequent tendency to move even further away from the equilibrium. The price dynamic curve is steeper than the 45-degree line. Instability and bubble. A self-reinforcing bubble is the outcome of an unstable equilibrium. Modeling crashes. How can we model the crashes? The positive feedback process can continue indefinitely until something happens to change the expectation of continuously rising prices. In the housing market, for example, as house prices kept increasing, builders continued to build them rapidly till there was a point when too many houses had been built. At that point, house prices started to fall and the bubble burst. Another way the bubble can burst is through the process of short selling, where people start to bet on lower prices in the future. A trader can attempt to profit from identifying a bubble by short selling. Short selling equals the sale of an asset borrowed by the seller when the price of the stock is high, with the intention of buying it back at a lower price and returning it to the lender, making a neat profit in the process. This can bring the prices back to fundamental values. Non-clearing markets. Sometimes markets do not clear, so quantity demanded is not equal to quantity supplied. This is usually because the price is not able to adjust. One example is for concerts or sporting events where the supply curve is vertical. Quantity of seats in the concert hall or stadium is fixed. In our example, it is 40,000. The price at which the market would be cleared is 225 pounds, but price set is lower at 100 pounds. At that price, there is excess demand of 30,000 tickets. This is where the price mechanism fails to allocate the good. Tickets get rationed by another mechanism. Scalpers usually buy up those tickets at the price of 100 pounds and sell it in the secondary market/black market at a much higher price. There is an economic rent of 125 pounds to be made on each ticket. The economic rent leads to the emergence of the secondary market, which helps to clear the market for concert tickets. Other reasons where markets might not clear is markets with controlled prices. Price ceiling is an example of price control where you cannot charge any more than what the government has set, and price floors are when you cannot charge any less than what the government has set. Rent control is an example of a price ceiling. In the graph shown, initially rent was 500 euro and 8,000 units were demanded and supplied. The market was cleared. Now if there is an increase in demand, new equilibrium price would be 830 euros, but if the government imposes a rent ceiling of 500 euros, this will cause a shortage of 4,000 units because at that rent 12,000 units are demanded but only 8,000 available. Rent control is put in place to help people who would not be able to afford the rent in big metropolitan areas. This will create an opportunity for someone to earn an economic rent of 600 euros by subletting their apartment for 1100 euros. However, that is not allowed. Government may instead put incentives in place to encourage building of new apartments and increase supply so the market may clear at 500 euros. Economic rents. Economic rent is a payment or benefit that someone receives that is superior to his or her next best alternative. Economic rents are the things that drive capitalism. It is the search for profits that makes capitalism work. There are two kinds of rents. Stationary economic rents arise in equilibrium and are persistent. Example, consumer/producer surplus, rents from bargaining, monopoly rent, or rent created by government imposition of price controls. Dynamic economic rents occur in disequilibrium and are eliminated via a rent-seeking process. Example, disequilibrium price setting, speculation. Some types of economic rents help capitalist economies function well. Example, employment rents, innovation rents, and dynamic economic rents, which provide incentives to buyers and sellers to change their behavior to arrive at the new equilibrium. Summary. In this chapter you learned 1. Role of economic rents in market equilibration. Market disequilibrium induces rent-seeking behavior which may help to clear the market. Rents can be stationary or dynamic. 2. The value of assets is uncertain and they can be resold. They are prone to positive feedback process that can generate bubbles. Systematic versus idiosyncratic risk. 3. Not all markets clear. Issues related to rationing, price controls, secondary market.